Hey everyone, how's it going? JD Strategic here. I hope everyone's doing great. Crazy day in the markets yesterday. So I got a long video for you guys. There's a lot I want to talk about. First, I want to talk about what happened yesterday in the markets, why it's significant in my opinion. Then I'm going to be talking about what is inflation, why I think this matters. Then I'm going to be talking about who controls inflation. Quick answer, it's the Fed and what their kind of goals are with inflation. Then I'm going to be talking about this kind of definition of transitory that the Fed has been talking about. Then I'm going to be talking about where things stand over the last 20 years and how we kind of got here. Then I'm going to be talking about my market outlook and kind of how this coincides with the market outlook I gave you guys a month ago. So if you haven't already, go to YouTube, JD Strategic. I gave my first market outlook a month ago. This kind of coincides with what's going on, in my opinion. But yeah, I really want to get into it. And most importantly, I'm going to be talking about how inflation affects you. And this is really, really key what I'm going to be getting into in this video. So I'm really excited. So I'm going to start off by talking about what happened yesterday. Crazy day in the markets. The stock market was down negative 4.3%. So this was the market's worst trading day since June of 2020. So this came after finding out the CPI data for August came in at 8.3%, which was a 0.2% above expectations. We were expecting 8.1%. So this exceeded expectations. So this was pretty significant. And if you look at kind of these expectations that analysts have had, it's not atypical for for the actual inflation to come out higher than the forecasted inflation. But as you can see, the month before, for the month of July, the actual came in lower than forecasted. So experts were kind of thinking, all right, inflation's finally starting to ease. They can take their foot off the pedal, but they were expecting 8.1%, but then it came in at 8.3%. So investors are like, oh my gosh, this is not what we want. So now that we're anticipating the Fed to raise interest rates at least one more time, and this could be a pretty significant base point hike. So this is what kind of spooked investors. And that's kind of really what happened yesterday. It came in worse than expected. Last time was a lot better, and investors wanted to hear some good news, which they didn't get. So that's really what we saw yesterday. And we saw over the month of June 9.1% inflation, which was the highest in 41 years. And then it went to 8.5, then 8.3%. So yeah, you could say inflation's cooling, but we'll get into later how this is a pretty misconceiving number. Whereas if you look at the monthly rate in June, that increase of 1.3% was pretty significant. Then in the month of July, there was no month-to-monthing. So it stayed the same over the month of July. Then in the month of August, we actually increased 0.1%. So there is reason to believe that inflation is not cooling by any means and is actually getting worse. So that's kind of what happened yesterday. So this chart's just going to go over the typical S&P 500 results over the last 10 years. This kind of excludes COVID. So there were 3 days where it was 10%, 13% losses. But if you just look in these last 10 years, in statistics, when you look at this first standard deviation, we're taught like that 95, 97, 99% confidence. You can see that most results of the S&P were in between -1 and 1%. And then we have some that vary in that 2% range and even fewer in that 3% range. But then when you see like this 4.9% in 2018, this day of negative 4.3% is a pretty significant day in my opinion. So we're kind of going to see how that plays out. And over here, you can just see the top 20 worst days in the history of the S&P. So yeah, we're not at these numbers yet, but when you look at these numbers and why they happen, these days were a lot more significant. You have Black Friday, you have the Wall Street crash of 1929, you have the financial crisis in 08, then we have COVID in 2020. And then during these times, you kind of see multiple days where the S&P gave negative results. Whereas yesterday, we didn't just get announced that there was a pandemic, there was no Wall Street crash. So 4.3% in one day is pretty significant. Just shows that investors are really scared on the CPI data and just don't have a lot of confidence right now. So that's everything on this slide. So in the next slide, I just want to start out by talking about what is inflation. And just on a very simple basis, this is just the rise in price, which means the decrease of your purchasing power. So when you look around today and you see gas going up, you see groceries going up, shelters going up, rents going up, transportation's going up. So that just shows, you have that same salary, you work for the same amount of money, but your ability to buy with that same amount of money is going downhill. So that's kind of just portrayed now more than ever, just that idea of inflation, where the same amount of money that you have is worth way less. So this is something that's really important for people to understand, just this idea of inflation, and it's why the wealthy just get wealthier. They understand this idea of inflation and that your bank account is really just going downhill, especially on a decade basis. So with that being said, I think the next question would really be who controls inflation? What is inflation? How did we get here? So inflation, as you can see in this chart, it's about 2 to 3% on an annual basis, and that's kind of the Fed's goal. And the Fed is the one that controls inflation through increasing or decreasing interest rates. And their goal with doing that is to keep this inflation. You can see this line at about 2 to 3%. But as you can see right now, we're at the highest point in over 20 years. So this is pretty significant data. And what happens when the Fed raises rates? That means you pay more in debt. That means there's less borrowing. That means the people spend less money, which in turn the businesses profit less. And some people see businesses not doing well as a good thing. But in reality, it's the firemen, it's the teachers, it's the everyday person that has their 401k invested in these businesses. So when the businesses are doing well, I mean, everyone's really not doing well as a result. So it really is kind of just a ripple effect through the economy. So I want to read this quote, and this is straight from the Federal Reserve website. And it is understandable that higher prices for essential items such as food, gasoline, and shelter add to the burdens faced by many families, especially those struggling with lost jobs and incomes. So the Fed acknowledges that inflation is going to hurt those that don't have jobs, people with smaller incomes. So the people that really are hurting the most, that's who inflation really affects. And they're pretty open about this on their website. So the next question would be, why does the Fed target this 2 to 3% inflation? Why can't we just have 0% inflation? Why can't the prices of goods remain stable over time? So the Fed's answer would be that the 2 to 3% number results in max employment and price stability. So when businesses and households, they can reasonably expect that 2 to 3%. Experts believe that we can make better decisions knowing that inflation number. So that means that people think that we'll make better decisions with our investing, our saving, our borrowing, when we can just anticipate that 2 to 3%. But the Fed says that if we get used to inflation below that 2 to 3% number, and then we start to become more accustomed to prices not changing, then we will overreact when prices do change, and that'll kind of make inflation a lot worse and cause prices to go skyrocketing at a lot greater pace. So that's kind of an interesting idea. So the Fed is basically saying that they know what's best for you and that they need to gradually raise prices. But I'm going to tell you right now, that you losing your purchasing power with your hard-earned money is definitely not the best. So, and this is really what the wealthy understand and what I want to kind of relay to everyone in this video. Having your money in the bank account while inflation is at its highest, and even when it's just at that 2 to 3% number, is really going to destroy that income that you work so hard for. So we need to find other alternatives to kind of put our money to work. So let's get into the next slide. So now this is really what I want to talk about and what I'm really excited to talk to you guys about. So this is the most important part, and this is what we need to understand about inflation. So when we calculate inflation, it's based off an index, and we're just comparing that on a year-to-year basis. So when we say inflation's at 8.3%, we're just comparing that from August of 2022 to August of 2021. So this can be kind of a misleading number when we're just looking at the last 12 months. Because when you look at this chart, since the start of time, prices, they're constantly going up. So yes, we could compare this to 2021 and see this 8% increase. But when you look far back to 1913, that's a much greater increase than 8%. So if your buying power is going down and that $100 is essentially worth $92 now, I think it's important to acknowledge how is that $100 going to look in 20 years, 40 years? Because in reality, you're holding your money in the bank account for probably longer than a year. So as you can see, this number is just getting crazy high, crazy high. So let's kind of get into that. So normally, as I said, we would say inflation right now would be at 8.6%, and this is reflected as of Q1 in 2022. It's 8.3% now. But this is just looking at inflation on that year-to-year basis. But what if we use other years as an index, which is what I wanted to show you guys here. So if we use 1913 as the index, inflation has gone up 2,874% since 1913. So that's super dramatic in my opinion. You know, when we look at $100 being worth essentially $92 in just the last year, you know, you're not going to have any money by these standards. So it is important to understand this concept. And then I think one number that I really want to point out that I think is very interesting is that I think we want to compare this to this 2000 number just to see, because most people they have their money in the bank account for 20 or 40 years probably. So let's look at 2000, and we can see that inflation, the cost of goods have increased 71% just in that 20-year time frame. So that's saying that your buying power of $100 would be $171. So that $100 is essentially worth $30 just in the 30-year time frame because of your ability to buy goods. So yes, you can still have that $100 in the bank account, but you're going to need $171 to buy what you could have bought with $100 in 2000. So this is pretty dramatic in my opinion, and something that I really just wanted to point out to you guys. So the next question, now that we've seen that inflation has been 71% since the year 2000, the next question would be, so we understand that the prices of goods are constantly going up, and they're going up 71% since the year 2000. So the question would be, okay, our salaries going up at the same rate? You know, our salaries going up 70%, whereas the money in my bank account is still worth the same. So I kind of went into that, and I wanted to look at the data from 2000 to 2021. And the index in 2021 was 126, whereas the index in 2000 was 118. So that's just shy of a 7% increase in salary from the years 2000 to 2021. So when you look at it, the prices of goods and everything around you going up 71%, and your salary only went up 7%, that's essentially saying that's a 64% decrease in you being able to buy goods. So this is super dramatic in my opinion, and just shows that you don't want to have that money in the bank account. It's going down at a very dramatic rate, and now more than ever. So let's get into the next slide here. Okay, so one other thing that I really want to point out, and this is kind of goes into this idea that I want everyone to understand this concept that the rich understand so well. And times like inflation, this is kind of an incentive for the government because it works out for them because they're able to pay off debt much quicker during times of inflation. So during times of inflation, that usually equates to higher taxes, so the government can pay off the debt a little bit quicker. And it usually means more people are getting taxed in times like this. and this reduces the real value of their debt. So I'll get into that for you guys. So let's say you borrow $1,000 at a 2% rate over the next 30 years. So there's 0% inflation. So that means the government in 30 years is going to pay you that same $1,000, and they've also paid you that 2% interest on whatever basis that may be. So that means investors are making the profit. You and I are making the profit. Whereas if inflation is 5%, that $1,000 is not worth the same. That $1,000 is worth $950 now. So that shows that the prices are going up, and the government's able to kind of charge these higher taxes on you. So let's kind of get into that example more. So inflation's 5%. That $1,000 is now worth $950. So the government doesn't have to pay you as much, and that 5% inflation, well, that's greater than that 2% rate that they're paying you. So those rates are essentially losing value. So overall, the government ends up paying less debt and they get more taxes. So the people are losing their purchasing power while the government pays less in debt. So the citizens are hurting while the people up top are really doing great. These politicians, the people in government are really succeeding. So it kind of works out well for them. So this is kind of something that we need to understand, that it plays to the government's incentives for the common people to not be doing as well and for our purchasing power to be going downhill. So next, I want to get into kind of this idea of inflation being transitory. So for the longest time, the Fed was saying that inflation was transitory, basically through a majority of 2021. But people are learning that it is here to stay. And I'm going to talk about why the Fed thought inflation was transitory. And it goes back to this year-over-year calculation where we just compared. So August of 2022, we just compared that to August of 2021. So when we look back to 2021, well, in March of April of 2020, we had a pandemic where the economy was shut down, the world was shut down. So we saw inflation of 0.3, 0.1%. So if you're going to compare inflation in 2021 to the year before of a global pandemic where the world shut down, that's going to be some skewed data. So hence why the Fed was saying that the data was transitory for so long. But at the end of 2021, Jerome Powell finally came out and said that transitory should no longer be used. And he discussed the slowing down of bond purchases, which often equates to a tighter monetary policy. So that was kind of his takeaway in the end of 2021. As you can see, he was realizing that inflation was no longer this transitory idea. And that's kind of what you can see at the end of 2021 here. As you can see, inflation starting to rise. They realized that it wasn't transitory and it was here to stay. Hence all these recent base point hikes that we've seen. So overall, you know, yeah, so we saw a couple base point hikes recently. So this is something that's pretty interesting. We've seen 4 base point hikes already this year, and we're kind of anticipating more to come. So this chart down here at the top, you can just see this is the normal inflation data. And then we also tend to calculate it minus the food and energy because they can be so volatile. But even those have kind of increased in the last month. So investors are definitely spooked a little bit. So that's kind of what we saw in the market. So this is showing inflation based off this 12-month period. And then this data goes back all the way to 2000. So as you can see, these numbers here, they're doubling, they're tripling these numbers. So in July of 9.1% inflation, that was that 41-year high. So these numbers are super dramatic. And like I said, towards the end of 2021, it was actually in November 30th where Jerome Powell said that inflation was no longer transitory. So you could see that these numbers, he could realize that, it wasn't fair to compare them to these small 0.1, 0.3 numbers. But now that these numbers were more legit, it was more of a fair comparison. You realize these numbers weren't going down anytime soon. They continued to trend upwards. And luckily, June to July, we saw that kind of decrease, and inflation didn't increase on a month-to-month basis. It stayed the same. So investors were hoping to see this kind of decline in this time period, which we didn't see. So hence that minus 4.3% drop. But yeah, prices have gone down dramatically. This 12-year can be a little bit misleading, like I said, so we can't totally pay attention to this. But it was noteworthy. We anticipated this 8.1%. So we didn't get that. We got this 8.3% number. So inflation may not necessarily be cooling for us. And some other statistics that I want to point out that we found in this August data, the food index on a year-over-year basis was at a 12-month high since May of 1979 at 11.4%. So food prices have increased 11% in the last 12 months. And then the other two statistics that I wanted to point out was that the cost of shelter has gone up about 6% in the last 12 months, and transportation services have gone up about 11% in the last 12 months. So between food, shelter, transportation, these are all like basic needs that everyone needs. And these are going up at dramatic paces over the last 12 months. So, and we don't see them cooling necessarily. So we can see investors not feeling as confident. And as a result, we saw the data react, we saw the market react appropriately. So that's kind of what we saw, where we stand now. And lastly, I kind of just want to get into finally, my outlook. And, I said I gave you guys that market outlook a month ago where I talked about a little bit about how a month ago we were at about 4,300 on the S&P. And I said in that video, I anticipate the S&P to hit 3,300, 3,400. That's kind of the number that would take for me to feel a little bit more confident. So that would have been a 30% drop. And we're currently at 3,900. So that's only a 10% drop. So I'm anticipating kind of a lot more. And why do I anticipate this? Because as a result of these rising inflations, and like I said, the government, they're slowing down their bond purchases. And so that means that we can anticipate rates to go up as a result. And as you can kind of see in this chart, when rates go up and when rates go down, the S&P tends to go up. So as you can see during this time when there were no interest rates, the S&P is going up at a very dramatic rate. Whereas now when we announce these rate hikes, the S&P is going down at a much dramatic rate. So like I said in that previous video, I anticipate the Fed to continue to raise rates. I'm anticipating 4 more rate hikes in my opinion. So this isn't really anything to get overwhelmed on. This is just something that we need to anticipate. Reuters just came out with a study and they said that 90% of investors are anticipating a 75% base point hike in September. So this is something that we really can expect over time. So we'll kind of see how that plays out. But it will definitely be interesting. And the Fed meets next on September 20th and September 21st. So that's when we'll find out on this next base point hike. But like I said, I anticipate this 75% base point hike, and I anticipate at least 3 more hikes because the Fed has been very open. Their goal is to get inflation to 2 to 3%, and we're at 8.3% now. So I think they have a long ways to go before we can see inflation at that 2 to 3%. I kind of think inflation's here to stay for a little bit. So the Fed is going to have to continue to raise interest rates to promote people to borrow less and push the spending limits down. As we've seen crazy amounts of growth during COVID, and S&P just continued to rise. So that's my market outlook for the video. I really want to show you guys what inflation is and what it's doing for you guys. I want to emphasize the point, since 2000, inflation has gone up 71%. So $100 would essentially be worth $30 now. So if that scares you, And that really does scare me. I don't want to have my money in the bank account. I want to have that savings account so that I have that fallback option, but I want to put my money into assets that are appreciating and going up over time. So, yeah, that's everything I wanted to talk about. You know, that's really my outlook for the today. I hope you guys found this video interesting. I really do like studying the market and telling you guys about what I saw and my thoughts and opinions. But I don't know anything, so I'm just trying to listen to people, and it's impossible to try to time the market, but our goal is really just to study history, just so that we can better prepare ourselves for moments like this, and just always stick with that long-term time frame. So thank you everyone for listening. JD Strategic tuning out.